And then, of course, if the estate is large enough, and in 2017 that means $5,490,000, whether your plan has a revocable living trust or not, the federal estate tax return will be required. Also, for married couples, if the surviving spouse wants to take advantage of the deceased spouse's portable exemption, the federal estate tax return will be required, even if the estate is small and whether or not your plan has a revocable living trust.
And then there's accounting requirements. Whether you have a revocable living trust or not, there's a fiduciary involved who's trying to settle things for other people. Now, by fiduciary, I mean somebody like a trustee who has duties to the people who are supposed to benefit under the trust. And it'll be the trustee's job, ultimately, to account to those beneficiaries. And that means accounting for every penny. It's a precise process. You start with the list of assets that exist at the time of death, and you include every penny of income that's come in, every dividend, every interest payment. You include the transactions that have occurred, sales and exchanges. You include the debts and expenses that have paid, the tax returns that have been dealt with, and the tax payments. And you show what's left over and what's there to be distributed. And the result, of course, is you want to be able to show to the beneficiaries that you as trustee have done a good job and that there's no reason for them to sue you. And you basically want them to release you from any liability because they'll agree that you've done a good job. And you really can't do that without an accounting, without a proper disclosure. That's one of the rules of being a good fiduciary. Before you can get an effective release, you really need adequate disclosure. So in the living trust situation, the trustee should be doing that just because that's a good thing for a trustee to do to protect himself and to show the beneficiaries that a good job is done. The difference between a revocable living trust and a will is that with a revocable living trust, you don't have to file that accounting in the probate court. Although in many cases it might be a very good idea, there's no requirement that you do that. In the other situation where there is no revocable living trust and there's basically it's the will and the executor executing the will, yes, the executor has to go through the same accounting process. It's required. And the account must be filed in the probate court. And it will show all the same things that I just talked about that a good trustee of a revocable living trust would include in his account. And both accounts would show the distributions that are posed and would be made. And of course, distributions must be made to finish the job. Now, sometimes we talked about how wills will create trusts for the benefit of others. You might remember the example of the single mother who wanted to create a trust for her daughter, and the trust was created under the terms of her will. Her will said, I give all my assets to my trustee to manage for the benefit of my daughter. Okay, you can have that type of arrangement either in a living trust or without a trust through the terms of the will. The question is, if you have a living trust, are there any advantages to how that trust that continues on for the daughter, for some other beneficiaries? Is there an advantage to doing that in a revocable living trust where probate is avoided versus doing it under a will, a testamentary trust where probate is involved? Just keep in mind, and people look at this in different ways, whether it's an advantage or not, I'm not sure. But when the will creates a trust, when it's a testamentary trust, and when probate's involved, the trust that's created for that daughter or other beneficiaries will continue to be subject to the jurisdiction of the probate court, and there will be accounting requirements. Now, the will can waive the accounting requirements to some extent, but it can't waive the final account. And at the end of the term of the trust, if the trust is a testamentary trust, that's a trust that's established by the terms of the will, then the trustee will be required to account in the probate court. Now, some people think that's a good thing because it keeps the trustee honest. And some people think that's an unnecessary intrusion, and why should the trustee be required to file the the accounting in the probate court. As a matter of fact, in New York, they don't have such a requirement. It can all be settled outside the court. In the revocable trust situation, after death, when the debts have been paid and the expenses have been paid, and the trustee of the revocable trust is instructed to hold on to assets in trust for the benefit of certain beneficiaries, well, there is no continuing supervision of the trust by the probate court. Now, there are situations where the trustee, because nobody's really watching very closely, will become too lax about it and not keep good records, and that can make for a horror show when it comes time to terminate the trust. Let's talk about the reasons for considering a revocable living trust. And as we've gone through this presentation, we've touched on many of these reasons, and there won't be a need to go into them in great detail. But one reason, and we think it's the most important reason, is revocable living trusts provide a good way to manage your assets when help is needed. And that means when you're just too tired or frail or not capable of managing your assets anymore, the revocable living trust is a mechanism for dealing with that problem. We also talked about, if you have real estate in more than one state, how a revocable living trust can be helpful in avoiding ancillary probate proceedings in those other states. In our next segment, we'll cover how a revocable living trust can help when you have a controversial estate plan.